Welcome back to another Wealth Code video, guys. Like, subscribe, and comment if you want to see more of our great videos. Have you ever wondered why the stock market keeps going up? Imagine the stock market like a giant global marketplace where people buy and sell pieces of companies, just like buying parts of an ice cream sundae. Each scoop represents a company's stock, and the more people want that ice cream, the higher the price goes. Recently, more people have been craving these scoops, leading prices to rise. This is driven by many factors, like companies making more money, low interest rates, and even government policies encouraging spending. When businesses perform well and create profits, buyers become eager to invest, thinking their investment will grow. Just like everyone flocks to the newest, yummiest dessert, investors hop onto boards of rising companies. Seeing that demand for stock, prices start to go up. But is it just because everyone wants a taste? Let's dig deeper and uncover the factors behind this intriguing phenomenon. One major reason for the stock market's rise is company profits. Think of a bakery known for its delicious, mouth-watering cupcakes. If they start making more cupcakes and selling them quickly, their profits rise. When a company, like this bakery, announces growing profits, investors get excited. They think, wow, this company is doing well. Just like people willing to pay more for that nicely baked cupcake, they rush to buy more stocks. Higher profits signal that the company is healthy and has room to grow, making its stocks more desirable. On the flip side, if a bakery runs out of cupcakes, folks might be less interested in investing in it. So, when companies share good news about earnings, the stock market reacts positively. More profits lead to rising stock prices and increasing investor confidence, setting the stage for continued growth. Let's explore more factors that can contribute to this growing excitement in the market. Another key factor pushing the stock market up is low interest rates. Picture this. You want to buy a house, but the bank says you'll pay extra money to borrow it. If interest rates are high, fewer people want to take loans, making the real estate market slow. Similarly, borrowing money for companies becomes pricey if rates are high, leaving businesses with less cash to invest and grow. However, when interest rates drop, it's like a sale on borrowing. Suddenly, buying that house or taking out a loan feels much more affordable. Companies also take advantage of these low rates to fund new projects and expansion, which often leads to higher profits. This excitement flows back into the stock market. Investors recognize that as businesses grow due to borrowed money, the stock prices are likely to rise. So lower interest rates not only encourage shopping for homes, but also stimulate investment in the stock market. Government stimulus programs can significantly impact the stock market's rise. Picture a community receiving extra funding to spruce up their parks and recreation areas. Workers get jobs, local businesses get a boost, and everyone is happier. When the government injects money into the economy, it helps people and businesses thrive. This increased spending means people have more money to invest. For instance, during economic downturns, governments might decide to send stimulus checks to support struggling families. With cash in hand, folks are more likely to buy stocks or spend on consumer goods. Businesses start to see the benefits and can improve profits, keeping that upward momentum in the stock market. Essentially, government actions can turn on a cash flow fountain that keeps the economy bubbling. With this cash flowing, investor confidence grows, leading the stock market to rise as more people jump in with their investments. Let's now take a look at how investor psychology plays a huge role. Investor psychology also plays a huge part in driving stock prices up. Have you seen how friends share the latest trend in fashion? Everyone wants the hottest outfits, and suddenly, shops can't keep them in stock. The same happens in the stock market, driven by something known as the fear of missing out, or FOMO. When people see others making money from their investments, a sense of urgency builds. They think, if I don't act now, I'll miss out. This kind of thinking can propel stock prices even higher. Just like that shopping frenzy, where people rush for the last trendy shirt on the rack, investors may flood in when they hear about rising stock prices. This increased demand leads to even higher prices. The more people pile into investments, the stronger conditions become for continued gains in the stock market. Understanding this psychological aspect helps explain why the stock market appears to climb even further. Let's explore trends next. Trends and innovations also fuel the stock market's rise. Consider the rise of smartphones. That tech revolution changed how we communicate and interact. Imagine if a company made a groundbreaking app that captured people's interest. Suddenly, everyone wants shares in that company, believing it will bring future success. New ideas and technology can excite investors, leading to increased stock demand. Think of companies like Tesla. Its innovation brought attention and investment that drove its stock up. When investors see a company leading in trends, they think, if I invest now, I'll reap benefits down the road. The stock market behaves like a buzzing party where everyone wants to be part of the latest trend. So, when cool inventions or promising trends emerge, stocks can rise sharply. This connection between innovation and investment creates a sense of excitement that propels the market upwards. Now, let's look at international factors influencing the stock market as well. Global events significantly impact the stock market's performance. Imagine a giant pie where different flavors represent countries. If one flavor, like chocolate, suddenly becomes scarce due to sourcing issues or trade relations, it affects the entire pie. Similarly, the stock market feels the effects of international happenings. For instance, trade agreements can open doors for companies to sell their products abroad, boosting profits and stock prices. Conversely, if there's political instability in a major country, investors may get anxious. The stock market reacts as fears arise. Global trends, such as economic growth in emerging markets, can also excite investors. Investors see opportunities globally, and their enthusiasm can impact stock prices at home. In short, everything in our interconnected world influences stock prices. So, being aware of international happenings helps make sense of what's causing the stock market to rise. Let's uncover the final piece of the puzzle in understanding stock movement: long-term outlooks. The long-term outlook is crucial for understanding why stock markets rise. Consider planting a garden. The flowers may not bloom overnight, but with good care and patience, they'll flourish. Investors usually focus on long-term growth instead of short-term fluctuations. When companies post strong financial forecasts or grow their market share, it paints a promising picture for the future. Investors start piling into stocks, hoping to reap the rewards over time. It's like nurturing a sapling, understanding that, although there may be ups and downs in the short term, the tree will bear fruit eventually. Many analysts believe that when the overall economy is healthy, the stock market tends to follow suit. Even if hiccups arise, the overall guidance and investments tend to create upward trends in the long run. So, the long-term vision of investors shapes buying patterns and drives stock prices up, contributing significantly to rising trends. Let's wrap up all these points. So, what have we learned about why the stock market is rising? We explored how company profits drive prices up, the impact of low interest rates, government stimulus, investor psychology, trends, global events, and long-term outlooks. All these elements play a role in creating a healthier investment environment. Just like when more people show up at a fair, the excitement grows. Prices climb with increased demand, driven by optimism and enthusiasm. As you consider investing, remember that understanding these concepts can guide your decisions. Stay informed and recognize how daily life converges with the stock market. Whether you're simply curious or prepared to dive into investing, this knowledge is invaluable. Don't forget to subscribe and check out more videos to enhance your financial know-how, or share your thoughts below. What surprised you most about our market exploration today? For more videos from Wealth Code, don't forget to like and subscribe.